I invest in VWRP. Should I switch to ACWI? I'm using FWRG. What about PACW? That's the lowest cost global ETF on the market right now. So should I just switch and use that one instead? This is one of the most common questions that I get asked. Should I switch from this global ETF to this other one? The bottom line is yes, for some people, you probably should switch, but for many of you watching, you actually probably don't need to and are overthinking it. So in this one, I'm essentially going to run you through everything they need to consider: fees, spreads, returns, the specific platform things, and one big tax thing that catches people out quite often. And ultimately, by the end of this, you'll know whether it's actually worth you switching or whether you're overthinking it and should just leave it alone and chill. I've also pulled together a checklist, which I'll go through at the end of the video, which summarizes everything. If you are new here, hi, I'm Ryan. I'm a chartered accountant, and I built my own investment portfolio to nearly £200,000, mainly using global funds, and I now help others to do the same. If you're not new here, then you're probably getting sick of hearing that. Honestly, it's fair enough. But if you need a hand with investing, check the first link in the description, chuck your email in, and I'll send you my free investing guide and 30-day course. Then after that, you'll probably want even more, which I can help with as well. Let's start with fees. This is the best place to start. It's also the main reason that I find through speaking to people why someone might want to switch in the first place, particularly when one headline fee, the ongoing charge figure, is lower than another. So let's look at the most popular global ETFs first for UK investors, as this really will then form the basis of our video, and then we can look into the fees and the maths in a bit more detail. VWRP is 0.19%. FWRG, which tracks the exact same index, the FTSE World, is 0.15%. ACWI is 0.12%. SSAC, which tracks the exact same index as ACWI, the MSCI All Country World Index, is 0.2%. PACW or PACW is 0.07%, which tracks a selected global index. From my experience talking to people and my own research, these are the 5 most popular global ETFs at the moment. So if you're in VWRP and you switch to FWRG, that's roughly 25% cheaper. So surely that's a good thing and a bit of a no-brainer. On one hand, it is. But on the other hand, whilst fees are important, as they are one of the few things in our control, they aren't the only thing that matters when picking a fund, despite what you probably heard online. There are other important factors when picking a fund, sometimes arguably more important factors. For example, one of them being the tracking difference. I've actually covered that in other videos, so I won't rehash it in this one. And for those ETFs I just mentioned, these are all popular large global ETFs, so it's not much of an issue in this case. But what I'm trying to say is there are actually other factors and criteria to look for when picking a fund. It's not just the fee, but I do appreciate the fee is very important. So regardless of all that, let's do the maths of a switch from VWRP to FWRG and work out the cost saving. If you've invested £10,000 for 30 years, growing at 7% a year after the respective fees, with VWRP you'd have about £72,000, with FWRG you have around £73,000. That's a difference of 1K compounded over 30 years. As you can see, it's not a huge amount. On the surface, don't get me wrong though, of course it's good. More money in our pocket is always great, and I will flash the numbers up on screen for 100K invested over 30 years at 7% a year, once again deducting the respective fees of each of the funds in this example. So I guess yes, it is more money, and that'll be obvious to you as the fees are lower, so there's slightly more money each year compounded in your own pocket. And once again, if you talk about even bigger numbers, say £1 million, then the absolute fee saving gets even bigger, but in percentage terms, it roughly amounts to about a 1% difference on your total pot over the long term, regardless of what pound amount you're compounding per month. So what I'm trying to get across is it's not make or break when you're actually selecting between these very low fee global ETFs. The biggest win or wins comes from cutting fees when you're moving from something genuinely really expensive down to something cheap. So for example, using myself, when I first started, I had my workplace pension and I got auto-enrolled into a fund, a life strategy type fund, charging 0.85%. I switched to a global fund for 0.2%. That was a massive fee saving worth over 75% in fee cuts. So that was big. Shaving off, in this example, 0.04% might not be worth it, especially when you take into account the spread fee. But first, when is it actually worth switching just to reduce fees? Here's how I personally think about it. And of course, it's just my opinion. I'm not a financial advisor, but I think if you're going to save more than 0.2% in fees, it's probably worth doing. If it's less than that, it's probably not worth doing. Of course, everyone has their own rules of thumb. You might be more or less anal with fees than me, but even switching from VWRP at 0.19% to PACW at 0.07% probably still isn't worth it in my opinion. Ultimately because the marginal gain, even when compounded, is tiny, and the actual cost of switching can wipe out the saving for many years, which quite handily brings me on to the spread fees. Let's talk about spreads. I'm putting this directly after this fee section because this is probably the biggest reason most people shouldn't switch. Spreads are the cost you incur when buying and selling an ETF. You don't pay them on mutual funds, but you do on ETFs. The spread is the difference between the buy price and the sell price. For a huge liquid ETF like VWRP, and really for a lot of these funds, it's absolutely tiny. For example, you're looking at HL's data, currently it has a spread of 0.03%. FWRG is similar, 0.04%. For smaller ETFs, newer ETFs, more niche ETFs, it can be a lot more though. But where I was going with this, and here's the thing, if you're constantly switching from one ETF to another, you're paying that spread fee every single time. Twice actually, once when you buy and once when you sell. Like in this example, moving from VWRP to FWRG will cost you 0.07%, which I do appreciate is a tiny number. So you're actually sort of going backwards for nearly the first 2 years because of those extra spread fees that you're paying when buying and selling. Of course, just to point out again though, mutual funds don't have these spread fees. So maybe with mutual funds, it could be more worthwhile because you'll avoid this spread fee. Another cost of switching, platform dealing fees. On some platforms, they can charge £5 or more per trade. And if you've got to pay these, it makes even less sense in my opinion. Once you have the spread fees and the dealing fees, it can start to add up and just not essentially make it worthwhile to switch global ETFs. There's even another cost you could incur, which probably is the biggest reason, tax. But first, there are actually some other important considerations when it's probably worth switching. The first one, is your current fund actually truly global? This is one I see all the time. People invest into funds like SWDA, WRDA, LGGG, and assume they're globally diversified, but they're not. These funds only invest into developed markets. They don't invest into emerging markets. I actually have a list of these funds that aren't truly global, as I call it, in my global index fund tool, which I'll flash up on screen. I'll link this below as well if you do want to get access to it and go through it yourself. If that is you though, switching to something like VWRP or ACWI isn't about saving fees. It's actually about having a portfolio that is truly globally diversified, getting the diversification that you thought you might have already had. And if that's the case, I do think the switch is genuinely worth doing, even if the new fund has a higher fee. Of course, that's my opinion anyway, and it does assume you want to be fully globally diversified. As a quick check though, go on to Just ETF or your fund's fact sheet, whatever you're investing into, and look to see if it includes emerging markets. If the answer is no, and you wanted a truly global or world fund, that's one reason where it is worth switching. Sometimes the reason to switch isn't about the underlying fund, it's actually about the version of the fund you're currently invested into. And this is another one where I think it is again worth switching. It's a very quick one, but just in case, most ETFs have an accumulation version and a distributing version. Accumulation means the dividends get auto reinvested, for example, VWRP. Distributing or income means the dividends get paid out to your investment account as cash, so VWRL. Same fund, same fee, but there's different dividend treatment, or the dividend policy of each fund is different. So if you're holding the wrong one and you want to hold the other one, it's probably again worth switching. The same goes for if you're accidentally using the wrong currency version of a fund. For example, VWCE is in euros rather than VWRP in pounds. An important point to make, can you even buy the funds you want to switch to on the platform? PACW, for example, currently the lowest cost global ETF, isn't available on every UK platform yet. That actually goes for the 2 brand new FTSE All World ETFs that just launched, both with a 0.12% fee. I covered that in a recent video, and I'll also link that below if you want to watch that video after this one. On this point as well, with these new funds, like these 2 new FTSE All World funds that have just come out, it's generally best to wait. I know it can be tempting to switch, particularly if the fee is much lower, but you want to make sure, generally speaking, the fund has a bit of a track record. I would say minimum 1 year. Ideally 3 years plus though. Why? Ultimately, it helps to make sure the fund actually sticks around and won't get shut down. Plus, newer funds often do have higher spread fees. That's because they are smaller and less liquid, so it costs more in those indirect spread fees to buy and sell them. But back to this platform availability point, before you even sign up to a new platform, most platforms offer a stock screener tool online. So you can just go onto it, plug in the fund you want to invest into, and see if it's even available. So you can actually check the funds on there before you even make an account. Type in PACW, PACW, or whatever fund you're considering, and you'll suss it out pretty quickly. For example, this on screen is Trading 212 screener tool, and you can search and see what is offered on their platform. This, another example, is Light Years One. Before talking about that taxes point, it is worth making a quick point on the returns of these funds. Now, of course, we all want the best returns. We all want to grow our wealth as quickly and as efficiently as possible. But the thing is, if two funds are tracking the same underlying index, the returns should be practically identical. There, unfortunately, is no magic in switching from VWRP to FWRG and making more money. They both track the same underlying index, the FTSE World, so they should deliver the exact same return. You can actually see this has been the case since VWRG came onto the market in 2024. On screen, ACWI and SSAC both track the MSCI All Country World Index. Once again, it's the same thing. There's almost identical returns. Even though PACW does track a slightly different index, a selective global index, once again, if you overlay the charts of all these 5 ETFs, they practically give the exact same returns. So I would just say here, and to caution you, don't switch to chase returns, as it probably won't do much. A lot of these global funds ultimately invest largely in the same way, although there is some nuances. The return should pretty much be identical, or at least very similar over the long term. Saying that, there is actually this weird thing that can happen, and you might have noticed it yourself, where a global fund, one global fund, can actually outperform another in the short term, and it usually goes something like this. The fund is new, and it comes onto the market. It has a small amount of money in the fund at the start, so it can't actually buy all of the underlying stocks in the underlying index, particularly with a global index where there's thousands of underlying holdings. As a result, the largest stocks that they do buy at first have a higher weighting in the fund. And if those large stocks outperform, whilst the fund is buying more and more of the underlying smaller stocks in the underlying index, then it could actually outperform other identical global index funds. This is actually what happened when FWRG came onto the market in 2023, and it can also work the exact opposite way in reverse. It's sort of potluck, but overall this is usually a temporary thing that happens with new funds sometimes, and is a weird thing I've observed myself over the years. And another reason as well why I don't usually want to look at returns too much, as over time the funds get larger, hold more stocks, and the returns converge and become almost identical. People, tax. The thing that probably matters the most in this video, if you're inside an ISA or a SIP, you of course can switch freely. There's no capital gains tax. You can sell VWRP one day and then buy PACW the next day, completely fine. Of course, there will still be spread fees, there may be dealing fees, but there's no capital gains tax to pay, importantly. But if you are investing in a general investment account, a GIA, switching could actually trigger a taxable event if you've made capital gains. For the current tax year, your capital gains tax allowance is £3,000. Anything above that gets taxed at 18% if you're a basic rate taxpayer, or 24% if you are a high rate taxpayer. If you're watching this past April 2027, just double check what the allowance and CGT rates are, as they can change. But if you've got, I don't know, say £50,000 in VWRP in a general investment account, and let's just say you got £15,000 of unrealized gains, switching to FWRG to save that 0.04% in ongoing fees actually crystallizes a £15,000 gain. 3K will be tax-free using the full CGT allowance, but 12,000 is then taxable, and that is 2 to 3 grand that you'll be paying in capital gains tax. It would take you, of course, decades in saving that tiny ongoing fee difference to actually make back that tax you owe. You'll probably never make it back unless you're investing huge amounts of money. So before you switch in a GIA, always do the maths. Now, if you are stuck in a GIA with big gains and you do still want to switch, there is a clever way around this called a bed and ISA. What you do is you sell your GIA holding using your 3K CGT allowance, immediately rebuy the new fund inside your ISA and spread it across multiple tax years if you have a lot of gains to avoid that capital gains tax. And I really do think the spread fees, along with any potential tax in a GIA, are really the two big points that come to my personal front of mind before switching. Here's another one though that no one talks about: the behavioral cost. Every time you tinker with your own portfolio, you slightly increase, just a little bit, the chance that you'll tinker again. And suddenly you've gone from a passive buy and hold long-term index fund investor to someone who is constantly chopping and changing their approach. So I do actually think as well, sticking with one fund, the one you chose originally, if there's not too much in it, is valuable in itself from the mental point of view. And you're still building that discipline of leaving your investments alone, contributing every month, and riding it out for the long term without panic selling, even if it's not necessarily the optimal fund from an ongoing fee point of view. As long as it's a good enough fund that you're happy with, and you can be consistent, stick to it. And that, in my opinion, is a big behavioral advantage of actually not changing anything up unless you really need to. Okay, so what is the overall conclusion? And when should you actually switch? Now, I, of course, love global index funds and ETFs. I've been investing in them myself since 2018. And they do, perhaps selfishly in my case, make for good content because there are loads of options, a lot of questions around them, and it's great that fees keep coming down. But honestly, to be completely transparent with you, it's pretty rare you'd actually need to switch, particularly if you're in one of the top pick low-cost global ETFs. The main reasons would be when you actually want to switch, if you're in a very high fee fund for whatever reason and can make a saving in the fee, if you're in a fund that isn't truly global and you want to be investing globally. For most people watching this, if you are already in one of those low-cost global ETFs, you can probably just keep investing, do that every month, and ignore all the noise. And if you do want to start investing in a different global fund, maybe because it's lower fee, then it's probably actually better to switch your future contributions there rather than selling your current holdings and moving everything over. Then there's, of course, no CGT trigger if you are investing through a GIA, and there's no spread or dealing costs either. I mean, but obviously saying that, and I am an investor myself that values simplicity, if you do want the simplest possible portfolio and just having one low-cost global fund that you think is the best, then copying the spread fees once when you sell and then buy just to switch your money over could be the simplest approach. Just don't get in a habit of chopping and changing your approach too much. The biggest gains in investing really come from how much you contribute, how long you stay invested, and actually not panic selling when markets fall, not by chasing these tiny marginal fee reductions, in my opinion. I've also pulled together this checklist, which is now on screen if you want to take a screenshot. Not financial advice, of course, but it runs through the key points from my point of view. And I think ultimately, if you tick the relevant boxes, go for it. Switch away. Of course, it's up to you. It's your money and it's your investments. But as I mentioned, I would say in most cases, and assuming you're already in one of the top pick low-cost global ETFs, then it's not worth switching. I love talking about global index funds and ETFs, as it's probably come across in this video. I really should get out more. It genuinely is 30 degrees today, and I've been melting inside. But I do invest most of my money into global funds. I've now got well over £100,000 invested in them that I built up over the last 9 years. So watch this video that I'll link on the screen next. You want to know exactly why I choose and follow this global index fund investing approach.